Imagine it's 1st December 2001. You are a 42-year-old shop owner living in Buenos Aires, Argentina. You have a small apartment with cracked tile floors, a used Peugeot parked on the street, and a daughter whose school fees are due next week. For 10 years, 1 peso has meant $1, so you believed the rules were solid and the future was something you could budget. Your savings are in the bank. Your suppliers are paid on time, and every morning you lift the metal shutter of your store, believing that boring discipline is how ordinary people climb. You are not rich enough to own farms in Uruguay or accounts in Miami, and not poor enough to live outside the banking system. You are exactly where responsible people are told to stand, in the middle. If you have ever wondered why the middle class so often follows the rules and still gets crushed first when the system cracks, stay with me. What you are about to hear is not a theory, it is a pattern. It has happened before. And it always feels shocking when it arrives, even though the tracks were laid years earlier. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then you hear the news. Economy Minister Domingo Cavallo has announced the Corralito. Cash withdrawals are now limited to 250 pesos, or $250 per week, per account holder. The money is still said to be yours, but now it sits behind glass like food in a locked cupboard. Customers stop buying. Suppliers demand cash. A line forms outside the bank, then shouting, then panic, then rage. Within days, the city feels like a theater where everyone has suddenly remembered the building is on fire. By 20th of December, riots spread, President Fernando de la Rua resigns, and before the month is over, Argentina defaults on about $141 billion of debt. The middle class had done what they were told. They saved in the official system. They trusted the bank, the currency peg, the monthly statement, the polite language on television, and yet when the floor gave way, it gave way under them first. That is what this video is about. Not just one crisis, not one country, not one bad leader. It is about a recurring historical pattern. When a society breaks financially, the poor suffer immediately, the rich often escape sideways, and the middle class gets hit in the chest. Their savings are trapped. Their homes lose value. Their salaries lag behind prices. Their pensions shrink. Their businesses lose customers. Collapse does not arrive like lightning. It arrives like termites in the walls. By the time the house looks crooked, the damage has already been done. Before we go further, there is something important to understand. The middle class is not usually destroyed by one single blow. It is usually destroyed by a sequence. First comes concentration. That means their life savings get packed into a few official boxes: a bank account, a pension fund, a mortgage, a family home, maybe a small business. Then comes dependence. Their income depends on salaries paid on schedule, credit staying available, schools staying open, and money keeping roughly the same value month to month. Then comes the policy response. And this is the part most people miss. In a crisis, governments and central banks do not choose between saving everyone and hurting everyone. Usually they choose where the pain will land. Think of society like a suspension bridge. The poor often have little weight on the bridge because they own few financial assets, even though they carry enormous daily hardship. The rich have private helicopters, they own land, foreign currency, businesses, lawyers, political access, and ways out. The middle class is the traffic in the center, dense, visible, highly exposed. When the cables start snapping, they are the ones standing exactly where the shaking is worst. This is why the middle class gets hit from both sides at once. If prices crash, their home equity falls and their retirement accounts sink. If prices explode, their cash savings and wages lose purchasing power. Purchasing power just means what your money can actually buy. If banks freeze, they are trapped because that is where their savings are. If taxes rise, they are easy to find and easy to charge. If governments rescue the system by printing money or forcing losses onto depositors, the middle class pays again. They are too visible to hide and too small to negotiate. And there is one more layer. The middle class often believes in the rules more than any other group because the rules are what helped them climb in the first place. They are the people who save, sign forms, wait in line, and assume that the contract will hold. In stable times, that trust is rewarded. In unstable times, that trust becomes a net thrown over them. The very habits that built their lives can turn into anchors when the water starts rising. This brings us directly to the first part of the pattern. The middle class is often told that safety lives inside the system. Then, when the system is threatened, that same safety becomes the trap. Argentina in 2001 is a brutal example because the country had spent the 1990s teaching people to believe in normality. 1 peso was pegged to $1. A currency peg means the government promises its money will stay fixed to another currency. Imported goods filled stores, families borrowed in dollars, salaried workers planned like Europeans. For a while it felt disciplined, modern, almost permanent. But underneath, the economy was rotting in the beams. Debt was heavy, growth was weak, and confidence depended on everyone continuing to believe tomorrow would look like yesterday. When that belief started to crack, deposits fled the banks. By the end, the government did not really stop the crisis. It only changed its shape. On 1st December came the withdrawal cap of 250 pesos or dollars a week. Imagine what that meant for a pharmacy owner, a mechanic, a family running a small grocery. Their money existed on paper, but not in the hand. The crisis turned a bank statement into a museum label. You could look at it. You could not live on it. What ordinary people experienced was not abstract. It was practical humiliation. Middle-class families who had never missed a payment suddenly rationed cash for groceries, rent, bus fare, and medicine. Small businesses lost sales because customers had cards but no notes. Workers were paid into accounts they could not freely access. Grandparents who thought bank savings were safer than hiding cash at home discovered that legal ownership and usable ownership were not the same thing. The state had not stolen their money in the dramatic movie sense. It had simply put a wall between them and their own lives. Then came the second blow. The one-to-one peso-dollar link broke. Deposits and debts were transformed through forced conversion, and inflation followed. That is the deeper pattern. First, the middle class is trapped in the formal system. Then the rules of the system are changed. A lifetime of careful saving can vanish not only through theft, but through translation. One day your savings are dollars. The next day they are pesos. One day your contract means one thing. The next day it means another. Collapse is not always a robbery in the dark. Often it is a rewrite in daylight. There were, of course, people who suffered even more than the middle class. Poverty surged and unemployment bit hard. But the middle class took a uniquely shattering kind of damage. The poor lose income during a collapse. The middle class loses identity. The teacher who thought herself prudent, the shopkeeper who trusted the bank, the clerk who followed every rule, all discover that the ladder they climbed is leaning against smoke. That is why these crises feel moral as much as financial. People do not just lose money, they lose the belief that doing the right thing protects them. And yet, even in Argentina, not everyone was hit the same way. Exporters with foreign earnings, landowners with hard assets, and those who had moved savings abroad or kept value outside the banking system had more room to breathe. They were not magically immune, but they were not handcuffed to a freezing bank account while prices and rules changed around them. The same storm. Different boats. Here's something I want you to think about before we go further. When a society tells ordinary families that their home is their retirement plan and their bank account is their safety net, what exactly happens when both are tied to the same fragile machine? Drop your answer in the comments. Seriously. Because what I'm about to show you next is the part of this story that most people reduce to a Wall Street story, when it was really a middle-class story. Now look at the United States in 2008. Different country, different language, different level of wealth, same pressure point. For decades, the American middle class had been encouraged to build wealth through home ownership. That idea was not crazy. In ordinary times, a house can be both shelter and savings. But by the 2000s, housing had become something bigger. It was the family vault, the college fund, the emergency cushion, the retirement dream, and the symbol of having made it. Too many hopes were stacked on one foundation. So when house prices began to fall, the damage moved through middle-class life like water through drywall. Quiet at first, then everywhere. The Federal Reserve later found that from 2007 to 2010, median family net worth in the United States fell by 38.8%. Median income fell by 7.7%. In 2008 alone, nearly 3.2 million foreclosure filings were made on about 2.3 million properties. The unemployment rate more than doubled, rising from under 5% to 10%. These are not just numbers, they are roof beams snapping. The mechanism was cruel because it attacked the exact asset ordinary families trusted most. Wealthy households had wider portfolios. Portfolio just means the mix of things you own: stocks, businesses, land, private investments, foreign holdings. Poor households often had little housing wealth to lose in the first place, though they suffered terribly through layoffs and rent stress. But middle-class families were often concentrated in one giant asset, the house, and that house was often bought with debt. Debt makes gains feel bigger on the way up, and losses feel fatal on the way down. It is like standing on stilts. You look taller until you fall. When home prices dropped, many families discovered they owed more on the mortgage than the house was worth. That condition is called negative equity. In plain English, it means the house can no longer cover the loan tied to it. So the thing that was supposed to make you secure becomes the weight pulling you under. What did ordinary people feel? Shame, confusion, a strange kind of silence. Foreclosure does not look dramatic from the outside. Often it is just a family pretending everything is normal for 6 more weeks. A father cutting cable but keeping the school shoes. A mother calling the bank again and again, hearing polite words with no solution inside them. a couple stopping at the kitchen table after the children are asleep, staring at numbers that no longer belong to the world they thought they lived in. The crisis was sold as a story about exotic financial products, but inside millions of homes it felt older and simpler than that. The map had changed, and ordinary people were still using yesterday's roads. What makes 2008 so important to this topic is that the middle class was not only hurt by the collapse, it was hurt by the shape of the rescue. The financial system was stabilized. Some institutions were saved. Markets recovered faster than wages. Asset prices eventually rose again. But families who lost homes, jobs, and years of savings did not bounce back at the same speed. Recovery in the aggregate is not recovery in the household. Aggregate just means the big national total. A country can look healed on paper while millions of ordinary lives remain cracked underneath. And that leads to a hard truth. When crises are solved from the top down, the benefits often flow first to those who already own financial assets in scale. The middle class, especially those whose wealth was tied to one house and one paycheck, can be left waiting on a platform long after the train has moved. In every collapse, timing matters. People with liquidity buy. Liquidity just means ready cash or assets that can quickly be used as cash. People without it sell, default, or freeze. This leads to the second part of this story. Sometimes the middle class is not crushed by falling asset prices. Sometimes it is crushed by being locked inside the banking system while the state redraws the rules around them. Look at Greece in 2015. By then, the country had already spent years inside a debt crisis with wage cuts, tax rises, and anger boiling under the surface. But on 28 of June 2015, after talks with creditors broke down, Greek authorities declared a bank holiday. That sounds gentle, almost festive. It was nothing of the kind. Banks closed. Capital controls were imposed. Capital controls are limits on moving money. ATM withdrawals were capped at €60 per day per card. The holiday was first meant to last until 6th of July. Banks did not fully reopen until 20th of July. Again, ask who gets trapped in a moment like this. Not the person with a lawyer in London, not the company with foreign accounts already in place, not the wealthy family with property abroad and cash in more than one jurisdiction. The person trapped is the pensioner with savings in a local bank, the cafe owner who needs to pay a supplier, the parents trying to cover summer rent and groceries, the pharmacist who needs imported stock. The middle class lives in the official plumbing of an economy. When the pipes are shut, they are the first to feel the thirst. In Greece, people lined up at ATMs not because the machines had failed, but because trust had. Money was there, but only in slices, €60 a day. That number matters because collapse is often measured in small humiliations, not grand speeches. €60 is groceries, €60 is medicine. €60 is the difference between feeling like an adult and feeling managed by strangers. Electronic payments inside Greece still worked in many cases, and pensions were specifically exempted in some ways. But the larger message was unmistakable. Your savings are not just yours. They are yours until the system decides they are systemic. Now, here's where it gets interesting. Greece was not a hyperinflation story like Weimar Germany. It was not a housing crash on the American scale. It was a banking and sovereign debt crisis inside a shared currency area. Different machinery, same social target. The middle class gets hit hardest because it is woven most tightly into formal promises. It trusts the pension, the bank branch, the ATM, the fixed salary, the official transfer. Those are wonderful tools in good times. In bad times, they become levers used on the very people who rely on them most. And there was a psychological wound here that numbers alone cannot capture. A middle-class life depends on rhythm. Salary in, bills out, savings accumulate, plans extend into the future. A bank closure breaks that rhythm like a drummer losing the beat in the middle of a march. Suddenly the future shrinks to the next cash withdrawal, the next pharmacy visit, the next supplier invoice. When that happens, people do not only become poorer, they become shorter in time. They stop thinking in years and start thinking in afternoons. By now you can probably feel the shape of the pattern. Argentina trapped depositors and then changed the currency rules. America tied ordinary wealth to an inflated housing market and then let the floor drop. Greece limited access to bank savings when the state itself was under pressure. Different countries, different decades, same bruise on the same body part. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe. Because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all of these cases have in common. The same mechanism, different countries, different decades, same result. The middle class is where modern economies store delayed life. Delayed life means the years of work you turned into bank deposits, pension rights, home equity, insurance claims, and business goodwill. That stored life sits inside institutions, a bank ledger, a mortgage contract, a pension fund statement, a salary agreement. When a crisis hits, those institutions become the battlefield. In every case, the authorities face the same basic problem. The promises already made are too large for the resources available. So something must bend. Prices bend, currency bends, access bends, contracts bend, taxes rise, wages lag, deposits are frozen, asset values fall. Rarely does a government stand at a podium and say, "Today we are destroying the middle class." Instead, it happens through technical language, emergency decrees, rescue packages, temporary controls, restructuring plans, and inflation that arrives like rust, quietly eating the hinges off daily life. This is why collapse is not a fire. It is a pressure system. If you push down on one part, another part bulges. Save the banks and savers may still suffer. Defend the currency and unemployment may rise, print money and cash holders bleed. Impose austerity, which means cutting spending and raising taxes to stabilize debt, and salaried households lose demand, security, and time. There is no painless exit from a leverage system. Leverage just means built on borrowed money and fragile promises. The question is never whether there will be pain. The question is who cannot dodge it, and the middle class usually cannot. The poor often have little formal wealth, though they endure brutal hardship. The rich usually have optionality. Optionality is a simple idea. It means having choices. More than one country, more than one bank, more than one asset, more than one source of income, more than one legal structure, more than one path out. The middle class usually has one or two paths, both inside the same system. That is why it gets hit hardest and collapses. Not because it is morally worse, not because it deserves it, but because it is the class with enough stored value to be worth targeting and too little power to refuse. At this point, the pattern becomes impossible to ignore. The middle class is the dry timber in every structural break. It is where the system finds usable resources, savings to trap, home equity to destroy, pension value to dilute, salaries to tax, trust to spend. And this is where history gets uncomfortable. The human cost is not just about who becomes poor, it is about who loses a lifetime of discipline in a single policy season. Take Weimar Germany in 1923. Hyperinflation, which means prices rising so fast that money becomes worthless faster than normal life can adjust, did not mainly punish the man with debt and hard assets. It punished the saver, the pensioner, the clerk, the widow living on fixed income. In January 1923, a loaf of bread cost about 250 marks. By November, that same loaf cost 200,000 million marks. Workers were often paid twice a day because wages could be nearly useless by lunchtime. By November 1923, $1 US was worth roughly 4.2 trillion marks. Imagine trying to preserve middle-class respectability in a world where the price tag changes faster than a heartbeat. The winners were revealing. Borrowers could repay old debts with nearly worthless money. Farmers with food and land could trade in something real. People with tangible goods, foreign currency, or assets that moved with prices had some defense. But the salaried urban middle class, the very class that trusted savings books and stable routines, watched the ice under its feet melt from below. Inflation is often described as rising prices. That is true, but incomplete. In a collapse, inflation is also a transfer machine. It moves value away from those holding cash and fixed claims toward those holding real assets, pricing power, debt, or political protection. Then look at Cyprus in 2013. This case matters because it shattered a comforting modern belief. Many people assume that if a crisis comes, insured deposits are sacred, and anything above that line is simply a problem for oligarchs, tycoons, and cartoon villains. But real life is more ordinary than that. In March 2013, Cyprus first proposed a one-time levy on bank deposits, 6.75% on insured deposits under 100,000 euros, and 9.9% on uninsured deposits above that amount. The final deal changed, and insured deposits were protected. But uninsured deposits were frozen, and at the Bank of Cyprus, nearly half of those larger deposits were converted into equity. At Laiki Bank, uninsured depositors ultimately received only about 6 cents on the euro. Who keeps more than 100,000 euros in a bank? Sometimes the very rich, yes, but also small business owners holding payroll, families who sold property and had not yet reinvested, older savers between life stages, professional people who thought keeping money in a Eurozone bank was about as boring and safe as finance gets. The middle class and upper middle class do not merely lose because they are greedy. Often they lose because they are administratively legible. Their money is sitting exactly where the state can reach it. Now add Lebanon after 2019. Here the collapse was slower, messier, and in some ways even more devastating because it stretched over years. The World Bank said Lebanon's crisis was likely among the top 10, possibly top 3, most severe globally since the mid-19th century. GDP fell from about $55 billion in 2018 to about $33 billion in 2020. By February 2023, the Lebanese pound had lost more than 98% of its pre-crisis value. Banks imposed harsh withdrawal restrictions. Depositors were often allowed to take out only limited amounts, sometimes in local currency, at exchange rates far below the real market rate. In simple terms, people were not only blocked from their money, they were forced to accept a smaller, weaker version of it. Who was crushed here? Teachers, engineers, retirees, families who had spent decades building bank savings because Lebanon's banking system had long sold itself as a pillar of stability. That is the cruel genius of many collapses. The more respectable and trusted the system looks before the break, the more middle-class wealth it can gather inside before the doors close. It is a harbor that turns into a net. You can see a softer version of the same wound in Japan after the asset bubble burst around 1990 and 1991. This was not a dramatic bank lockout or a wheelbarrow of cash inflation story. It was slower, colder, more like a long winter settling into the bones of the middle class. Land prices fell for years. Stocks collapsed. Families who had believed property values only moved in one direction discovered that a home can stop being a ladder and become dead weight. Salaries stalled. Promotions slowed. Careful people did not wake up one morning ruined in theatrical fashion. They just looked up a decade later and realized the future had quietly shrunk. That matters because not every middle-class collapse is explosive. Some arrive as a drawn-out erosion in which ambition itself is worn down like stone under dripping water. In every version, the classes that come through best usually own things that do not depend on one local promise: productive land, export income, foreign earnings, businesses with pricing power, which means the ability to raise prices without losing everyone, or simply enough cash and legal flexibility to move early. Meanwhile, the middle class is often holding claims rather than control. A claim on a pension fund, a claim on a bank deposit, a claim on home equity, a claim on next year's salary path. Claims are powerful in normal times. In abnormal times, control beats claims. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what did the survivors have in common? Not the lucky few in a single country, but the recurring types who came through history's storms with less damage than their neighbors. The historical record shows that those who came through these periods largely shared three characteristics, and none of them required prophecy. First, they were not completely dependent on one institution, one asset, one currency, or one income stream. In plain English, they did not build their whole house on one pillar. A farmer with food, a merchant with foreign customers, a family with some savings outside the domestic banking system, a worker with a skill that could travel, all had more breathing room than the person whose entire life sat in one local account and one monthly salary. Second, they understood the difference between nominal safety and real safety. Nominal just means safety on paper. A number in a bank account can look stable while its real value is evaporating. A pension can still arrive while buying half as much food. A house can still be yours while the debt against it crushes your mobility. Survivors tended to focus less on official labels and more on lived function. Can I access it? Can I use it? Does it keep value when rules change? Does it depend on trust staying perfect? History shows that the people who kept asking those boring questions often looked paranoid, right up until they looked prepared. Third, they adapted early, while society still mocked early movement as overreaction. In Argentina, people with savings outside the frozen system had options. In the United States, families who treated housing as shelter rather than a cash machine were less exposed. In inflationary episodes, those who shifted toward things with real use value, or at least avoided sitting entirely in cash, suffered less. In banking crises, people with social networks, flexible income, or access to outside markets endured better than those who waited for official reassurance to become reality. The middle class is often taught that patience is maturity. History shows that in a structural crisis, patience can become a trap if it turns into passivity. Notice what I am not saying. I am not saying there is a magic asset that always wins. History does not offer that kind of comfort. Every crisis has different machinery. What it does offer is pattern recognition. The people who survived best usually had flexibility, redundancy, and realism. Redundancy means backup, more than one plan, more than one source of stability, more than one place where value could live. When the bridge shook, they were already closer to an exit, and now we return to Buenos Aires, to that shop owner on 1st December 2001, staring at the bank line and trying to understand how a country can tell you your money is safe while preventing you from touching it. In the months that followed, people like him did what middle-class people always do in a collapse. They improvised, they cut spending, they bartered, they leaned on relatives, they delayed dreams. Some closed their shops, some lost years of savings, some rebuilt in a cheaper, harder version of the world that came after. That is the final lesson. The middle class gets hit hardest in every collapse because it stands at the exact meeting point of trust and exposure. It owns enough to be wounded and too little to be protected. Its wealth is stored in the promises of the system, and collapse is what happens when those promises are repriced, delayed, diluted, frozen, or broken. The poor suffer first in the body. The middle class often suffers deepest in the structure of life itself, and the wealthy, more often than not, have doors that open before the smoke reaches their room. History does not tell us the future in a straight line, but it does leave fingerprints. Argentina in 2001, America in 2008, Greece in 2015, Weimar Germany in 1923, Cyprus in 2013, Lebanon after 2019, different flags, different speeches, same underlying pattern. When the system strains, the middle class is the shock absorber. It is expected to trust, to wait, to pay, to adjust, and to believe the emergency is temporary. Sometimes it is, sometimes it is not. But by the time the official language becomes honest, the transfer has often already happened. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it, but if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.